Lindsey, I don't want to get into the silliness of pivot this or pivot that. Where are we right now? What is your real GDP call for this ending Q4?
Well, I do think there's enough momentum or ongoing resilience in the consumer that we will see a second quarter of positive activity, albeit markedly below the near 3% pace we saw in the third quarter. But the bigger question is, can we maintain that going into 2023? And I don't see that resilience being able to be maintained as we continue to see some of these variables increasingly weigh on the consumer, i.e. elevated prices, negative income growth, negative manufacturing activity, a housing market that's under extreme pressure. So I think that we can argue you can check the recessionary box for nearly every sector of the economy, even at this point, except for the labor market. But even there, we're starting to see cracks. We're starting to see signs of emerging weakness. So while we do maintain that positive trajectory through December, I think 2023 is opening the door for recession.
Let's do Algebra Monday, Lindsey. It's Y equals, I don't know what it is, C plus I plus G plus NX is out there somewhere. Can you split your analysis between domestic final sales and real GDP? Can you pair off trade dynamics? Or are they part of getting to a recession?
Oh, absolutely. And I think when we parse through the trade and inventory data, that's really what complicates the earlier weakness that we saw at the start of the year and why it's likely that we don't see a technical recession in hindsight called for the first 6 months of 2022. Because when you strip out that volatility from trade and inventories, we see that we actually had positive momentum from December into the first quarter of the year. So this is very much complicating the picture and will continue to complicate the picture going forward. If we look at third quarter GDP, now, one of the largest contributors to that top line increase was trade, contributing nearly 3%. But a lot of that was reflective of the weakness on the import side. And that reflects a declining demand or a level of declining demand on the consumer part, again, highlighting the fact that consumers are on increasingly fragile footing as we turn the calendar page into the next year.
Lindsey, there will be some people tuned into this program right now listening to another recession call for 2023. And wondering why on earth the Federal Reserve is hiking interest rates by 50 basis points on Wednesday and probably signalling they're going to do a whole lot more after that. Lindsey, how do you reconcile those two things?
Well, remember, the Fed is trying to slow the economy. So the fact that we're seeing increasing calls for recession in 2023 means that the Fed's earlier policy initiatives are already having the intended effect of tapping down investment, tapping down consumption, and resulting in a significant slowdown in the economy. Now, the reason the Fed is so focused on continuing to raise rates, not necessarily at the supersized 75 basis point increase that we saw earlier, but 50 basis points, and as you said, more work to come down the road, is because inflation is still elevated. And at this point, with the labor market still arguably on modest footing, the Fed is hyper-focused on bringing down inflation, reinstating price stability, which the chairman has said time and time again is the bedrock of the economy.
So how much more damage do you think another 100 basis points of heightening does?
Well, I think it ensures that we do see recessionary conditions, but depending on the behavior of inflation, depending on what we see in terms of international factors, that will determine the depth and duration of the downturn. But again, from the Fed's perspective, it's not about whether or not we see negative activity. It's about whether or not we can get inflation on a meaningful downward trajectory back towards the committee's desired 2%-ish target range.
What's your probability of getting back to 2% until England wins in football again, Lindsey? I mean, come on. Where are we getting back to 2%? 25 or is it 26?
Well, if you look at the Fed's trajectory, they're still very optimistic that we're going to see a two-handle by the end of 2023, maybe early 2024. But I think the reality of the data suggests that committee members have been calling for this meaningful improvement in inflation for the better part of the past 2 years, and we simply have not seen that come to fruition. So the Fed, the market continues to underappreciate the complicated nature of the inflation equation at this point. And that's why, along with a 50 basis points increase this week, we do expect the Fed to meaningfully revise higher their expectations for policy and inflation going forward.
This is Piegza 101. It's service inflation, isn't it? I mean, we're going to get a reversion. And David Malpass at World Bank was great on this years ago. We're going to get a legit goods disinflation, dare I say, true deflation. But services isn't going to get there. What do you see as a sustained services inflation above 3%?
I think that's absolutely reasonable, but you're right. We are going to see this bifurcation between goods and services, and already we're seeing it in the data outside of inflation. Manufacturing turning back into contractionary territory while we look at the ISM Services Index, and that is still arguably on solid footing. And so this bifurcation, again, does highlight the difficult nature that the Fed is going to face in trying to tackle broader inflation pressures, particularly as we see this wage price spiral continue to accelerate.
Lindsey, you and John are way too young to understand this. We survived this before. If we only come down with services elevated to 5% or 4% or 3.8%, life goes on, right? People adapt, right?
Absolutely. And we will come out of this. But I think the trajectory of how we come out of this depends on the Fed's resolve to reinstate price stability. If they start to get cold feet, if they start to pull back prematurely, then we could see inflation become entrenched in the economy, meaning that we don't see that improvement back to the Fed's 2% target. But if they stay the course, it will be more painful in the near term. But we could see the economy emerge faster and with more gusto as we begin to get back to a potential level after that 2% target is reinstated.